Welcome to this explainer on why stock prices actually move. You know, for a lot of people, the stock market just looks like this chaotic, giant wall of numbers, right? Just flashing green and red with absolutely no rhyme or reason. But today, we're going to peel back the layers. We're going to look right at the actual machinery underneath it all to answer that one massive question. Why do these prices actually move? Once you grasp the simple concepts we're going to cover today, you'll see the market isn't random at all. It's actually this incredibly fascinating, highly logical system. To kick things off, I want you to imagine a super common real-world scenario. You open up your investing app and you see a company's stock has suddenly dropped by 10%. Naturally, you go check the news and you find something completely baffling. The company just reported record sales, record profits, literally one of the best years in their entire history. And yet the stock tanked. Now, flip it. Imagine a company reports a massive loss. Revenue is totally shrinking, the headlines are awful, yet the stock price shoots up. So, how on earth can both of those situations actually happen? This is the exact paradox that trips up almost every single beginner. Most of us just naturally assume that stock prices move up or down simply because a company is doing well or poorly today. But honestly, that explanation is missing the biggest piece of the puzzle. Understanding the answer to this one specific paradox is literally the key to unlocking how the entire financial world operates. And I promise you, by the end of this explainer, this exact scenario is going to make total sense. All right, let's start at the absolute ground floor. At its core, the basic, unbreakable rule of the market is that supply and demand dictate every single transaction. Every time a stock is traded, there are two sides, a buyer and a seller. It really is that simple. If more people want to buy a stock than sell it, the price goes up. If everybody is rushing for the exits and wants to sell, but nobody wants to buy, the price falls. This supply and demand dynamic, that's the mechanical engine behind every single price tick you ever see. Think of it like buying concert tickets. Imagine there's a massive, highly anticipated stadium tour. If tens of thousands of people want a ticket, but there are only a few hundred left, what happens? The price skyrockets, right? People are willing to pay a huge premium. But if it's a concert nobody really cares about and there are thousands of empty seats, the sellers literally have to keep slashing their prices just to get anyone to show up. Stocks function exactly the same way. The market is basically just a giant global auction where prices are constantly, and I mean constantly, adjusting based on what buyers will pay and sellers will accept. But hold on, why do people actually want to buy these tickets in the first place? Well, when you buy a stock, you aren't just buying some flashing ticker symbol on your phone. You are buying a slice of actual ownership in a real-life business. And more importantly, you're acquiring a claim on the future success of that business. Imagine you bought a small, local restaurant in your neighborhood. Would you only care about how many burgers they sold today? Obviously not. You'd care about how much money that place could make over the next 5, 10, or even 20 years. Stock investors are exactly the same. They are constantly looking ahead. And that perfectly solves our opening paradox. Let's say Wall Street analysts expect a massive tech company to earn $10 billion this year. The day comes, the numbers are released, and the company reports profits of $9 billion. Now, step back for a second. $9 billion is a staggering, record-breaking pile of money. It's a great year. But because the market expected $10 billion, investors are super disappointed. Reality fell short of the expectation, so the stock price falls. It turns out, expectations matter way more than reality. The market is basically an expectation machine. It constantly compares reality to what it thought was going to happen. Professional investors spend their entire lives building complex models just trying to forecast those future outcomes. So stock prices usually move when those expectations change, not necessarily just when the reality itself happens. They are a reflection of a collective forecast. This is why a struggling company that was expected to lose $1 billion but only lost $500 million might actually see its stock shoot up. The reality was bad, sure, but it was way better than the terrible expectation. Now, while expectations are totally the driving force, the actual day-to-day performance of the business is the foundation those expectations are built on. Over the long run, successful businesses make for successful investments, period. Investors obsess over core metrics: revenue growth, profit margins, cash flow, and competitive advantages. They're constantly asking, is this company getting stronger or is it getting weaker? A business that proves it can consistently grow its profits is naturally going to attract way more investor demand, which pushes the price higher. But of course, companies don't just operate in a vacuum, right? They live inside a massive, incredibly complex macroeconomic system. Think about it.
When the overall economy is booming, GDP is up, lots of people have jobs, and consumer spending is high, businesses naturally sell more stuff. Profits go up. This makes investors fundamentally more optimistic across the board, which lifts the broader stock market. On the flip side, if inflation spikes and people lose their jobs, consumers stop spending, profits shrink, investors get spooked, and prices generally fall.
And out of all those big economic factors, there is one that acts like a giant, heavy seesaw for the entire market: interest rates. When central banks keep interest rates really low, borrowing money is cheap. So businesses expand, people buy houses and cars, and economic activity heats up, which usually makes stocks rise. But when interest rates are high, borrowing gets super expensive, and growth slows down. Plus, if investors can get a solid, risk-free return just by leaving their cash in a high-yield savings account, they'll pull their money out of the riskier stock market. Less demand for stocks means lower prices.
Beyond the big economic stuff, the market is constantly digesting an absolute fire hose of daily news. Earnings announcements, changes in regulations, new tech breakthroughs, geopolitical tensions, it all moves the needle. Let's say a pharmaceutical company suddenly announces regulators approved a breakthrough drug. Investors instantly calculate, wow, this means massive future profits. Demand for that stock spikes immediately and the price jumps in seconds. The market is a ruthless machine that takes today's news and instantly asks, okay, what does this mean for future value? Now, if markets were only driven by cold, hard math, investing would be a piece of cake. But humans are the ones making these decisions, and humans are emotional. This emotional layer is what we call market sentiment. When optimism morphs into full-blown greed, investors buy frantically, pushing prices up way faster than the actual business justifies. But the opposite is also true. When fear takes over, panic selling can cause prices to totally crash, even if the businesses themselves are perfectly fine. In the short term, psychology can absolutely dominate the math. Because of all this, the shifting news, the economic data, the human emotion, prices bounce around constantly. We call this volatility. Now, I know a lot of beginners see rapid price drops and think, oh no, the market is broken, I'm losing everything. But honestly, volatility is completely normal. Think of it like a weather app on your phone that's constantly updating as new satellite data rolls in. The stock market is just continuously recalculating its forecast for the future based on brand new information. Volatility isn't a glitch. It's literally just the market doing its job. Okay, let's do a quick rapid-fire myth-busting session just to make sure we're totally aligned here. Myth number 1. Good companies always see their stock prices go up. The reality? Nope, not if the expectations for that company were way too high to begin with. Myth number 2. A falling stock means the company is failing. The reality, sometimes temporary fears or short-term economic hiccups drag down the price of a phenomenal business. And myth number 3, volatility is just legalized gambling. The reality, as we just talked about, it's really just the market processing new information in real time. So how do the pros actually navigate all this chaos? Well, successful investors adopt a very specific long-term mindset. Instead of completely stressing out over daily, emotionally driven price swings, they focus intensely on the actual quality of the business. They look at financial strength, they look for competitive advantages, they deeply understand that in the short run, the stock market is just a crazy popularity contest driven by news and noise. But in the long run, strong businesses create serious wealth. They just practice patience. If you take away only one single thing from this entire explainer, let it be this. The stock market is not simply measuring today's reality. It is constantly trying to price tomorrow's possibilities. It's not a historical report card grading what happened yesterday. It is a living, breathing prediction engine that is totally obsessed with forecasting what will happen next. Which brings us to a final thought I want to leave you with. Every single price movement, every massive stock rally, every terrifying market drop, and all the volatility you will ever experience in investing, it all ultimately boils down to answering one question. What do investors believe the future will look like? The collective answer to that question is what pushes trillions of dollars around the globe every single day. Keep that framework in mind, and I promise you will never look at a financial headline the same way again. Thanks so much for joining me on this explainer.